Hello again. Thank you for joining us. If you'd like a quick introduction to UCITS ETFs, check out our previous video. And if you want to learn about the basics of UCITS liquidity and market structure, watch here. In this episode, we're going even further under the hood, exploring how underlying liquidity works in fixed income ETFs, using US Treasuries as an example. An ETF should be at least as liquid as the securities in its benchmark. This means that investors can achieve strong trading outcomes even when trading sizes far exceeding aggregated average daily volumes, or when an ETF is relatively new. How is this possible? It comes down to the open-ended structure of the ETF wrapper. When trading surpasses typical average daily volume levels, market makers provide liquidity by sourcing shares directly from the ETF issuer through the creation-redemption process. Consider a 1 to 3 year US Treasury ETF with 92 bonds in its benchmark. If an investor trades 1 billion of ETF shares, a market maker creates 1 billion worth of ETF shares by delivering either 1 billion in cash or 1 billion in value of any of the 92 eligible US Treasury bonds to the issuer. Both the issuer and market maker assess the cost of this activity to minimize expenses that would otherwise be passed on to investors. What drives these costs? A large portion comes from 1. Tracking error, 2. Bond execution costs. Both are influenced by the underlying liquidity of those 92 bonds. Because Treasuries carry less idiosyncratic risk, fixed income ETFs can sample the index rather than fully replicate it. This avoids trading the most expensive bonds while maintaining duration and risk targets, ensuring the ETF tracks the benchmark effectively. The result? Trading costs on UCITS ETFs can often be lower than trading all bonds individually, making ETFs a flexible, diversified, and cost-efficient wrapper. Measuring bond liquidity. Issuers and market makers use metrics such as bond-specific repo activity, dealer hedging, and inter-dealer trades. These benchmarks show that a single trade would need to exceed 1 billion to truly stress liquidity. Even then, trading is possible, but it's best to contact your local Vanguard representative and an ETF capital markets expert to optimize execution costs. Market makers often act as bond dealers too, enabling greater efficiency. Through the creation and redemption process, they can seamlessly transform bonds into ETFs, or even facilitate trades from one ETF to another ETF. If you have any questions about ETF liquidity, whether across ETFs in general or for a specific trade, Vanguard is here to help, wherever you are. Reach out to your local ETF capital markets specialist and we'll be happy to assist you in achieving efficient execution and keeping more of your investment returns. Bye for now.